you want to work in sell-side equity research, and every job you've ever seen is looking for someone with 2 to 3 years of equity research experience already covering that specific sector. I know what you're thinking. How do I get a job in a profession that requires me to have already worked in that very profession? Well, I'm here to show you how that works. If there's one thing you take away from this video, it is this. You have to know how to do the job before you get the job in this profession. If you cannot answer technical questions about accounting, fundamental analysis, and valuation, if you don't have a sharp, actionable idea that you can explain clearly, you're not getting a job in this field. Let that sink in right now. On the flip side, if you love what you claim you want to do, it will show. You will eat everyone else's lunch and get so many offers. With that, I want to highlight a few big misconceptions that you must avoid to be able to break into and, more importantly, succeed in the profession. When a job description says they're looking for someone with 2 to 3 years of experience, that's just a rule of thumb. That's for the recruiters. They don't know any better. Generally, people who have survived 2+ years on the sales side, they are a plug and play if they move to a new seat, especially within the very same sector. So they're always preferred over you as an outsider. But the great thing about public equity is you can work on your skills without getting the job. If you can come in and prove you can model, you can interpret earning results, you can value a business, you know what moves stocks, and you don't have any personality flaws that I can comfortably put you in front of company C-suite and institutional buy-side clients, I will give you that interview if you network hard enough to get my attention. It's just that most of you don't have the passion and the discipline to work hard to bridge that skill gap perception. Don't prepare for an interview. Prepare for the job. It's really beta to only focus on getting a job at all costs. If you cannot do the job after you get the job, you will lose the job. In most cases, there will be no training once you break into the profession. Senior analysts are always more fixated on generating revenue and building more relationships because that's most important to the franchise's success. If you limp your way into a seat, you will still fail. Why not actually get good at researching companies starting today so that you will shine once you're on the job? Sell-side equity research teams run really lean. The biggest sector probably has 5 to 6 people, and people rarely leave. You probably have noticed how few jobs there are every year. Although me running the job board, I can tell you there are actually more job opens than you think every year. Who hires for equity research? Well, there are the big banks. I don't go by the bulge bracket or whatnot because it's not really a equity research lingo. But that will be your Goldman Sachs, JP Morgan, Bank of America, and Morgan Stanley. And then you have the regional/middle market banks. Some example here will be TD Cowen, Piper Sandler, Raymond James. And finally, you have what is called the research boutiques. They don't have investment banking services. So in a good way, they tend to be more objective and monetize based on the quality of their actual research. Typically, the boutiques are founded by legendary analysts who did build a brand in the former 2 categories. The big ones here will be Bernstein Research, Wolf Research, Melius, which came from Barclays Industrials, and Nephron, which came from Barclays Healthcare. Now you know the lay of the land. You need to work on 2 things. 1 is to source jobs. 2 is to work on your stock pitch. First, leverage all the job boards out there. So create LinkedIn job alerts with keywords such as equity research. The problem is LinkedIn won't always show relevant openings. So you have to sort through one by one to ascertain whether that's actually a sell-side job or some random stock option administrator job at a corporate. And you have to cross-check against company's website to make sure it is an active search. But LinkedIn isn't the only resource you should use. You should set up job alerts on firms that have career websites. The problem is each firm's website has a different HR system. So for some firms, you have to bookmark the website and check it every day. While for others, you can set up alerts to be emailed to you daily or on your preferred cadence. And don't forget about the broader finance job boards. Platforms like eFinancial Careers should be checked regularly as well. There are also niche job boards that cater to specific professions. For example, I've come across Doc Jobs, which focuses on biotech equity research roles. It's a helpful resource for MD, PhDs in life sciences who are looking to transition into the corporate/finance career path. So with all of these job board options, the process can get overwhelming really quickly. And that is why I created my own job board to aggregate all the research job openings daily and save you time. I handle the cross-checking and validation and set up alerts with all the firms for you. So if you want to check it out, I've included a link in the video description. A lot of people have benefited from it. That way, you can focus on the most important task of networking and refining your stock pitch. As your network grows, you will notice senior analysts publicly seeking references for team openings. So check their LinkedIn or Twitter for posts like, hey, I'm hiring an associate on my team. When you spot those status updates, send a tailored DM with a work product, which is your stock pitch, to try to start a conversation. Definitely be on the lookout around the beginning of the year into March and April, because that's when the associates start leaving after disappointing bonuses. The second piece of your job lead sourcing is the good old network, because a lot of the jobs in the profession are filled by referrals and internal hires. Being connected to the people in the industry is a must to be top of mind when a job opens up. But also the best way to learn about your future boss's work style and team culture and how they're differentiated on the street. You can talk to the junior associates, the senior analysts, i.e. the managing director or director who leads the sector coverage on that team. And finally, the director of research. Whom you talk to depends on where you can build affinity. Talking to the people on the sector team gives you a more relevant sale because openings will come from that specific team. And you will get the intel you need when it comes time to decide on whether to join their venture. Every firm has a director of research. They run the entire equity research department, and part of their responsibility is talent sourcing. So you should try to build a lasting relationship with the DORs as well. The pro is he or she can put you in touch with any future openings within that firm. That gives you more shots on goal. The con is you still won't know the idiosyncrasies until you talk to the members of the hiring team. That said, the DOR are very useful top-down funnel and should be included as part of your job search process. To find people's contact information, you can always Google for equity research reports. That's an easy way to figure out your contact's email address or the email format for a particular research firm. There are sites like Rocket Reach that tell you the probability of the email format for a particular firm. Unfortunately, you are out of luck if the firm uses the initials of their middle name in the email address. If you run into that situation, you have to ask people in the ecosystem how to get in touch with someone you want to talk to. In my experience, some long form, like a thematic report or a primer, those equity research reports sometimes can contain the entire research department's roster with their email addresses. And some firms just list their analysts on their website with their emails. So this is where a little resourcefulness can help. In preparation for the networking, you'll need three things: an intro message, a stock write-up, and the Excel financial model that ties with your stock write-up. Your intro message should convey why you're reaching out. If there is a current opening, say, hey, I'm interested in working on your team. If not, say, I hope to learn about your successful career in equity research, even if they're not successful. You need to get your story together. Where you came from professionally, why you want a career in sell-side equity research, why you like stock investing, and how your path prepares you for sell-side equity research. There are always a set of transferable skills there. Keep it concise and to the point. Wall Street people are really busy and they all have very short attention span, so do their clients. So it is 100% your responsibility to make the sale by being persistent and persuasive. It is a numbers game, but you have to approach it appropriately. Lead with a stock pitch. Attach your stock write-up and the Excel financial model to prove you have the technical skills, because senior analysts will always prefer current sell-siders. First of all, the laterals they can model. They already know how to write. Second, they already understand a typical sell-side workflow. The latter is impossible to learn without being in the seat before, but your stock pitch can 100% reduce someone's concern about your technical skills. Make sure you pitch something outside your interviewer's covered industry. If you're interviewing with a media analyst, just pitch a non-tech stock. Be as far away from TMT as possible because you don't want to go head on with an absolute expert. I've gotten comments before. Someone says, Well, what if I really wow the expert with a totally contrarian view in a name they cover on a day-to-day basis? Yes, you might be, but the goal is to get the job. The goal is not to win an argument. So why not go with the path of least resistance versus climbing Mount Everest just to win a battle? And if you want to broaden your opportunity set, you have to prepare more stock pitches. For example, if you have a stock idea in a semiconductor space and in healthcare, you can go for two broad sectors by pitching the healthcare stock to the tech analyst and vice versa. And here comes the best news. You don't even need to be correct on your stock call if you're new to sell-side research. As long as your pitch is well rehearsed and you can show what drives the business and your thesis makes sense, it's more than what the outsiders can offer. That said, you could impress even more by knowing the big industry trends that the analyst covers. This way, you're showing interest in the sector by asking good questions. And everyone wants to talk with someone who cares about what they do professionally. And that's a huge brownie point if you made an effort to demonstrate that you have done some homework into a conversation. Even if you're talking with a paper and packaging analyst, which to me is just not that interesting. No offense. Have a call to action. Try your best to set up an in-person meet. It's always most effective if you do everything in person. But if not, settle for a video or phone call. Do not reach out during the following times. Don't reach out on Mondays because people are catching up on work after the weekend. During market hours, because obviously they're paying attention to market movements and they're serving clients. During earnings season, so when the big banks release earnings, that's when you know the earnings season has begun for Wall Street. And people tend to be busier during those 4 times in a year. And holidays because people don't want to be talking about work during vacation. And avoid Friday afternoons, especially during a long weekend because most people are kind of checked out and they're ready to head out to the Hamptons if they have a place there. If you don't hear back after 1 week, follow up once and follow up again after 2 weeks. If it's still radio silence, take the hint. Don't follow up again and move on. There are plenty of fish in the sea. For those who responded to your introduction message, try to make the most out of the conversation. You should prepare for it as if it's a real interview. The hiring team wants to assess the following things. Can you model and write? Do I like you? Which is really important. Am I comfortable putting you in front of the buy-side clients or the C-suite while representing my team? Are you committed to the profession? They know most of them aren't, but you still have to convince them. I argue most candidates are equally competent on the technical skills, but the soft skills play a huge role in this business. This is a relationship conduit business. So your preparation should address all of these points. So make sure you work on things like fashion sense and just the ability to speak fluent English. And that's particularly true for non-native speakers because you need to communicate well verbally and in writing to sell your ideas to the salespeople who then sell your idea to institutional buy-side clients, which are the hedge funds, mutual funds, or family offices that trade single stock. To paint you a picture, in sell-side equity research, your day kicks off with a morning call when your boss has an idea to pitch. Every day around 7 a.m. New York time, the salespeople gather around in a big conference room to hear a lineup of senior sell-side analysts pitch their ideas or thematic reports. If you cannot communicate your idea clearly or concisely, like in under 2 to 3 minutes, those salespeople, they just won't bother calling their buy-side clients about it. And if that happens, well, you're gonna lose your job because you could be the smartest person in the room, crushing the analysis and be correct on a stock call. But if you couldn't sell your idea, no one's gonna know how great your work is. And no one benefited from your analysis or your idea. That's not just a sell-side thing, that's life in general, but in sell-side research, that's especially true. And let's talk about financial modeling really quickly. Colleges are not gonna teach you this stuff, so you got to teach yourself. The basic investment banking courses, they're great for learning the mechanics, but to really stand out, you just gotta take it a little bit further. Think about the drivers of revenue and cost for a business, especially when the company themselves disclose that kind of information. It's really embarrassing if you don't account for that. So don't just plug in revenue grew by X% or cost is Y% of revenue. You got to go a little bit deeper. Think about, from common sense, how businesses work. We're not really just cranking a 3-statement model, which AI can do, anyone who's taking an IB modeling course can do. We're just expecting you to add some unit economics to your 3-statement model so you show us you understand what is really driving the business. That alone will set you apart from others who are just keeping it at the surface level. And I can immediately tell you have no idea what drives the business, and your assumptions going forward make zero sense. If it's just like 10% baseline revenue growth for the next 5 years, and you're adding 2 minus 2 for your bull and bear case, it makes no sense. Here's another way to level up. Know what the numbers actually mean. Like, I was coaching someone once, and I asked, what's working capital? He just rattled off the textbook definition. Oh, working capital is current assets minus current liabilities. But he had no idea what it actually meant for the business. That's the difference right there. We're business analysts trying to translate what happens with management decisions and strategic decisions into financial results. At the end of the day, you're analyzing through their financial statements what the implication is. If this is your own business, it has money implications when it comes to working capital. Here's an example. Say your company gets paid in cash by customers, but pays suppliers on credit, i.e. you can pay them within the next 30 days. Forget about all the finance and accounting definition. That's an awesome situation for you as a business owner, right? You can reinvest the cash you got from customers to grow the business. You don't have to pay your suppliers with the cash you got from your customers right away. Let's flip that around and compare that with a business that doesn't get paid cash for their sales, but has to pay their suppliers in cash right away. That's not great because you have no cash coming in upfront, but you have to pay your suppliers right away, and you got to come up with the cash somehow, let alone investing in the business. You might have to borrow from a bank, from some working capital. They explicitly call that working capital financing. Or you have to borrow from your friend or your business partners. So all else being equal, that first company is more valuable because that cash flow dynamic. See, it's not about how much Excel you know. It's not even about how much financial modeling you know. It's about translating numbers to business and translating business to numbers. Everyone can add and subtract. It's about understanding what those numbers mean for the business's future based on its present and its past. And that's the whole job of a stock analyst. It's valuing a business based on what's going to happen going forward in terms of free cash flow generation. A lot of you come to me with the question of, what about I'm coming from this profession, Big Four, private wealth, FP&A, middle office risk. What's my chance of getting into equity research? It doesn't matter where you came from, as long as if it's not a traditional path that equips you with the core technical and soft skills. You think your situation is really unique. It's not. Regardless of where you came from, you gotta develop the skills the sell-side equity research profession expect from you before you get the job. That's all it takes, because they will always want to hire someone who already have the skills, and there are plenty of them. Namely, 2 pools. One pool is current sell-side equity research associates. The second pool are people who work in investment banking, and you need to level that playing field. So get your story right, develop the skills, and convince the people who make hiring decisions. That's the 3-part approach. There's nothing unique about you coming from these aforementioned background. One other thing people often miss about sell-side research is the do I like you factor. People skills are a huge part in this job because at its core, it's a sales job. You can say that for a lot of high-paying jobs, but that's particularly true for sell-side research. It's even in the name, sell-side, especially at the senior level. Before I joined the industry, I totally underestimated how much they meant when they said sell-side, the sell part. I look at my former boss. As a senior analyst, he's managing relationship with tons of people. Public company CEOs, CFOs, equity salespeople internally, institutional buy-side investors, and other contacts within the industry ecosystem to help you understand your sector or provide channel checks for institutional clients. These are billion-dollar companies, and you are expected to know how to behave and interface with these top decision makers. At that level, there's not nearly as much spreadsheet work. It's all about your people. So when they're hiring juniors, they're not just looking for someone who can crunch the numbers. It will be your job early on to crunch the numbers, but they are looking for someone who can be groomed into the next talking head on CNBC or on Bloomberg. If you are worried that you're not personable enough for this client-facing profession, don't stress out. There is hope. It is called Dale Carnegie. It is called Robert Cialdini. Start by reading their books and actually practice the techniques in your daily personal and professional life. If you want more, check the video description. I've linked my people skills book list there. I've read every single one of them, and they have been more life-changing, frankly, than all the finance books I've ever read. Now, let's talk about team fit, because this is a small team-based profession, and fit is everything. When you're interviewing, do your homework on a team. Look for common ground and bring it up during your conversations. Maybe you went to the same alma mater, you have the same hobbies, you have the same favorite book, or even a similar previous career path. This is not just for their benefit, because you also don't want to spend 60 to 80 hours a week working with people who treat you poorly, and they don't want to hire someone who doesn't pass the so-called airport test. And that's the code for would I want to be stuck at the airport with this person. I touched on previously the topic of convincing them you're committed to the profession. Let's be real. A lot of you are secretly aiming for the buy side. By now, sell-siders know the game. Even the lifers know a lot of you will come and then go. But in the interview, you still need to convince them that you're committed to the profession. The key is showing that you appreciate what makes the sell-side research unique from the buy side. So talk about things like exposure to a diverse array of investment styles, because that is your job on a daily basis, to talk to both pod shops and a long only. So how do you stand out? People in this business love to talk about storytelling. So learn how to tell your story. What makes you, you? Why should they hire you? It's not about your resume. It's about how you present yourself and what unique qualities you bring to the table. You should never assume you're less competitive just because you don't have the exact relevant experience. From my experience, you never know what special trait of yours will tip the scale to your favor. When I was breaking in, I had zero professional equity research experience, yet I got the job over someone who has 5 years of experience in the field. I knew that because my teammate told me. Why? It turns out they were looking for someone with statistics and data skills that my team really valued. And that's a proof of being growth-minded and leaning into your unique strength can make all the difference. Now, a underdog mindset can be a great motivator, but you gotta channel it effectively. But you still gotta prove you have the core competencies that everyone else brings. Being able to rap like Kendrick Lamar is great, but if you don't know how to read a 10K, that won't help. For example, do you have real industry experience? Maybe you work in life sciences sales, or you were a oil and gas engineer, or you were an app developer. Don't underestimate how valuable hands-on industry knowledge can be. Some college grad can read 10Ks all day, but you bring real insight from your real world experience. If you ask veteran analysts in this field, they will tell you the biggest aha moments in their career didn't come from crunching numbers. It came from talking to people at conferences or management or visiting actual plants, not just by staring at a spreadsheet. And if you got special skills, make sure you highlight those too. For example, programming, always a game changer. If you know VBA, if you know SQL, if you can automate workflow, that's huge. Lots of busy work to be automated. If you're good with BI tools like Tableau, Looker, Qlik, Ultrix, you will stand out even more because most finance majors don't have these skills. Bottom line, think about what makes you unique, lean into it, as long as fundamentally you're a strong candidate with real technical skills. Combine that with a growth mindset, you will set yourself apart from the crowd. I hope this helps. If you want to break into equity research, go ahead and click on the next 2 videos in the upcoming screen. Thanks for watching. I'll see you in the next video. Peace.